The way that people are learning how to trade is the reason why 90% of traders, and maybe including you, are not profitable. Look, a quick internet search searching trading patterns, you will find endless pieces of content of people telling you these patterns that is the holy grail and that is the magic key to being profitable in price. These harmonic patterns and shapes cannot explain to you why price moves. Rather, you need to understand the true market mechanics of how price is formed. Without that right learning foundation, you will waste years and tons of money before you even realize it. Now, unfortunately, with the existence of social media, it's made it very difficult to find really true and valuable information on the internet. It's created a very fine line between knowing what's real and what's not real. And unfortunately, so many new traders are falling and getting sucked into this because they're new to the industry. They're gullible. So they spend years and tons of money hopping through various different mentorships, but are not actually getting anywhere with their trading. And no other beginner video is going to show you what I'm about to show you. Trading is undeniably one of the best ways to make money online. If you've clicked on this video, you would know that trading has the power and the ability to click on a button and make money online. No paying staff, no paying rent, no paying wages, no paying salaries, no electricity costs, no overheads. It really seems like the best way to make money online, right? No rent, no customers, no products. What better could you ask for? And with all of these different prop firms popping up that can now give us access to millions of dollars in capital with over 85 to 90% profit splits, it's literally never been easier for traders in this world. There are 20-year-olds, much like myself, that are taking advantage of this to make more than what doctors get paid. But you see, there's a catch. The trading world and social media is a very confusing space. There's a lot of noise and it's very hard to figure out what's real, what's not, what is the valuable information, and where can I find it. We have the blind leading the blind. Live stream traders that don't actually have a proven or profitable edge, that is more worried about their ego and rather will try to sell you a mentorship or a monthly subscription to whatever they have to offer. And this used to be me. But I gave up on it. I couldn't be bothered to actually put in the effort into mentoring anymore, so now I no longer do it. But what I'm getting down to is the wrong guidance, you're going to lose money, you're going to waste your precious time, and you're going to get so confused. So look, I'm just a random guy speaking to a camera through a microphone. And here's the part where I'm supposed to give you a bit of an appeal to authority in this industry. My name is Jay Froneman. I am the founder of Mechanical Methodology Funded, aka MM Funded. I've helped hundreds of traders get consistently profitable, get funded, and not only stay funded, but continuously maintain payouts on their funded accounts using the power of mechanics and my systematic strategy. Here's just a tiny snapshot of some of the results of hundreds of my students that have gotten funded and acquired their first ever profit splits over time. Using the exact method I'm about to teach you, not just one trade, not just luck, but an entire system and a proven profitable long-term edge that is based on market logic. And that is what I'm going to show you in today's video. And I'm not just going to show you what to do, but I'm also going to show you why it works. Because in my experience and from what I've seen, it's only once you have that true understanding that you will be able to execute your profitable edge every single time flawlessly, which is the biggest requirement for long-term profitability and long-term wealth in this industry. And I will be 100% transparent with you. Trading is hard. Most people don't make money consistently. Just because some of my students got these results, it doesn't mean you are going to get the exact same results. I cannot guarantee you that you will get the same results as my highest performing students. But what I can guarantee, these are the results of others who are using this rule-based systematic strategy based on real market logic. For everything that I'm going to show you today, I want you to know that I'm also speaking from experience. I started my career as a web developer at 14 years old with a big passion in the IT and computer space. Finishing high school, I became a YouTuber looking to diversify into different industries. And that is where I came across Matt Don Leavely at Photon Trading and where I learned the power of mechanical trading strategies and decided to pursue this industry full time. You will find that I influence a lot of my ideas, the way that I structure things around him, because he's a big influence in my life. I don't trade the exact same way he does, but my model comes a lot from his psychological side behind the systematic and rule-based way of trading, which I've now been trading for 7 years. I've been able to buy a Mustang at 19 years old, bought my first V10 supercar at 21 years old, and as of recent bought my first proper supercar, a McLaren, at 23 years old. I have a very vast experience in the trading industry, and it took me many years to understand the true market dynamics that I've implemented into my systematic strategy that you're going to receive and learn from me in today's video completely for free. And not only that, but also witness the impact that this has had on the hundreds and thousands of students that I've been fortunate enough to mentor over the years. I'm going to give you everything that you need and nothing that you don't. By the end of this video, I'm going to give you the opportunity to live trade with me completely for free. This is not going to be some high-level montage to spike your dopamine and to get you all hyped up, tricking you into thinking that you've achieved something, because there's no point in doing that, because you will actually never end up applying what I'm going to teach you. So today, I'm going to make sure bring out your true potential and performance so that you can start making money long-term in this industry. I'm pretty sure if you've been in the trading space before, you've all been introduced to TradingView.com, where we all have these charts of various different assets that we can trade around the world. Commodities, forex, stocks. But now we have all of these complicated black and blue bars, for some of you maybe red and green, depending on your chart colors, candlesticks that go up and down on our charts. The first thing that I want to cover with you before we actually dive into the systematic strategy is what actually causes these candlesticks to print. Is it a computer? Is it a massive server on the internet, on the cloud, that randomly prints out these candlesticks that tries to get people to buy and sell at specific areas in the market? What actually happens on the back end of these candlesticks and how are they formed? And this is the first thing that we need to understand if we want to become a profitable trader, is what are the market mechanics that actually move these candlesticks up and down? Well, what you're seeing on your chart here is not just colorful candles going up and down. Every single second, this price point moves up and down as this counter goes. These are hundreds, if not thousands, and hundreds of thousands of people all over the world, institutions, businesses, banks, you name it, placing orders on these markets. And essentially what all of this is, the market is simply a two-way auction. On the back end of these candlesticks in this market is what we call an order book, where we will see a whole bunch of different prices with various different sell orders at those prices, and vice versa for different prices where there are a ton of different buy orders. And this is what we visually see when we hear the two-way auction, is the constant auction between buyers and sellers battling for price on the market. Here's a bit of a more better and visually appealing example. This little white box in the middle at 1.21 of whatever the specific market is, this is where the last trade occurred and where current price is at. On the bottom side, where all of these green boxes are, is all of the demand at these prices at these lower levels. And at the top side is all of the supply at higher prices above the most recent order. Think of this like an auction, right? Where we've got buyers and sellers bidding on eBay, where different buyers come in with their different offers on the prices, and as each buyer puts in an offer, the next buyer obviously has to increase his price, and the person with the highest bid ends up winning that particular product. So what I'm saying is no trades can take place unless both the buyer and seller agree on a price. So therefore on the markets, to execute an order, it must be paired with an opposite side order of equal size. So meaning, let's say I buy 100 worth of this particular pair at below prices, price needs to go up to these higher prices to collect the equal amount of 100 orders that I've bought from this particular market. Because again, to execute my order, it must be paired up with an order on the opposite side of equal value. So let's take a look at this example over here. At this current price of 1.22, where there are currently 200 lots busy sitting at this price point, if all 200 lots are willing to be sold at this price, there must be somebody at the demand area willing to buy that price at the equivalent 200 lots. Otherwise, nothing's going to happen, right? You can put your order here for 200 lots, but unless there's somebody that is got the or willing to buy at that same position for the same 200 lots of equal size, then that trade can happen. But if there's nobody willing to buy that price, at the same price for 200 lots, it's going to be impossible for your trade to happen. So technically, trading isn't trading. It's actually just auctioning the entire time. So what I'm getting to is all of these candles that are constantly moving up and down. If I come to the 1 minute, you'll see it much better. Okay, every single candle that is printed every single second that this market moves, we will see this candle busy bouncing up and down, moving up, moving down, moving up, moving down. And what we're seeing here is the constant two-way auction of these orders in the order book of buyers and sellers selling and buying price, buyers needing to match the sellers and sellers needing to match the buyers. So now that we understand a bit of this market mechanic, what logically do you think we need to do to take advantage of this? Well, we want to buy or sell at a better level than the current price. We want to sell price high, right, to make money. And when you buy price, you want to buy price as low as possible, at the cheapest prices, so that we get a good price and that we get a bargain and that we're not overpaying for it. And if you want to do that, we do what we call, where we set limit orders, or what we call pending orders, which is the particular way that I trade. A typical way that you use these is if you want price to come up into your particular limit order, for price to then run to your intended direction or wherever you intend to target, and vice versa. For a buy limit, you want price to come down to your particular buy level where you're buying at low prices, where you expect price to then continue up to more expensive prices to your particular area that you are wanting to target and move price, right? So that is essentially what we are doing in the markets. We are just auctioneers in this two-way auction. But Jay, how does this help me? It doesn't matter. I just want to make money in this market. I don't really care what the market does. But this is the thing. In order to be long-term profitable in the markets, you need to understand what's actually happening behind the market mechanics that is happening here. All of these passive orders that you're seeing here is limit orders on the market. So these are buy orders and these are sell orders, waiting for price to come to these particular levels to collect them and then to move back up to all of these sell orders to match the amount of buy orders in order for all of these trades to be valid and to happen. So that is why we see price move up and down like this. All right, we're going to all the sell orders, fetching the buy orders, moving to the sell orders, fetching the buy orders, moving to the sell orders, fetching the buy orders, moving to the sell orders, fetching to the buy orders. And that constant auction action that we're seeing on the back end in the order book is what is presented to us as retail traders around the world in the form of these candlesticks. So now that I've told you this, hopefully you can now see that these candlesticks is not just a random up and down movement of colorful sticks happening on your chart. It is literally auctioners and buyers and sellers, millions of them around the world, battling for price, buying and selling against each other, auctioning for the best prices. And all of that warfare, what I like to call it, is presented to us in the form of these candlesticks. So now that you understand that, this will allow you to read these candlesticks and ultimately to take advantage of this for a profit. So let's put all of this into a more practical example and start to see and build this and put this together so that you can understand how to actually take advantage of this liquid instrument of auctioneers and money constantly being transferred, bought and sold and auctioned for in this market, and how we can essentially take advantage of that to make a profit. Okay, so now that I've explained how the orders work in the market and how it's printed to us, well, what you've just learned is when price fetches the opposite side orders, buys orders, sell orders, etc., price will be printed in the form of structure. All right, so in a bullish market, we will be creating higher highs with breaks of structures to the upside, and essentially higher lows that are protecting each other, not getting broken to the downside. This means that in this current market, there are more buy orders, there are more auctioners buying price than what they're selling price. All right, so every time a low breaks structure to the upside on this liquid instrument, there's a lot of buying power here. There's a lot of buyers busy auctioning price at these low levels to move price higher, to collect those opposite side sell orders. And once selling power starts to overtake the buyers, we will start to take out the buyers. Now, price is creating strong highs, what we call lower highs and lower lows. Now, sell orders are in power, taking out the buy orders. There's stronger selling power than what there is buying power. Now, I'm not going to get too technical with this. I'm going to keep this short, sweet, and simple. And this is essentially the first criteria in my profitable trading model, is using in what we're seeing with the structure that's printed in front of our eyes to our advantage. What the strongest lows that we all know is going to be protected and get the best reactions for the best profit, and vice versa, the strongest highs that have been created to get the best reactions to make the most profit. All right, so as I've just explained, in a bullish market, price will be creating those higher highs and higher lows. If you've looked at price before, it doesn't always look as clean as this. In a realistic example, what price will actually do is something along these lines. We'll create that higher high, pull back, the break to the upside. We'll then break structure to the downside. But then we suddenly break structure to the upside, confusing the various traders trading this market. Are we now bearish with a strong high, or are we now bullish again? Continue or expect to continue to go long? How do we know? How do we know who or which auctioneers are in control of the market? Well, in a bullish scenario, we'll see a pullback and a break. Okay, we must be bullish. We've broken structure. We are creating those higher highs and lower and higher lows. Okay, but then what we'll see is a break to the downside and then a break to the upside. Okay, so what are you seeing that is common here? The lows that are created after taking out a previous strong low are the strongest points that you can ever find in the market. Strong lows and strong highs are also the strongest form of liquidity. And once you see a sweep of that, you know that there was heavy institutional involvement. There was either a hell of a lot of sellers or buyers involved in that particular area and price, pumping these orders into that particular market to either take out the sellers or to take out the buyers. Now, when price needs to come and fetch all of these buy orders, there is, in a bullish scenario, there are a ton of these buy orders resting at these cheap areas in this range that price will need to come and collect to fulfill the sell orders. And because there are so many buy orders, there's a very low probability and chance that the sellers will overtake the buyers at this level. Okay, so that is criteria 1 in my strategy. Taking advantage of the auction and the order book is we use strong lows that has been taken or created after it took out a previous strong low. Okay, and it's the exact same vice versa in a bearish scenario. What we look for is bearish structure, the pullback, the break, a pullback, a new break, and then a sweep of that strong high. Now creating a break of structure to the upside, where a ton of people are going to think that this is now a bullish market. But what we see is that break to the downside, a pullback, break, and then a break structure to the upside, but then a break to the downside. Okay, these highs that are taking out these previous strong highs means that the sellers in this area of the market are selling prices at very expensive areas, means that the sellers have taken out a hell of a lot of these buy orders, completely overpowering and overtaking the market with a lot of sell orders in this particular expensive area of the market. So when price pulls back to these areas, there is a very good chance price won't fail this high and get the best reaction, because there is so much sell orders here in the order book that it's nearly, I'm not going to say next to impossible, but maybe next to impossible for the buyers to overtake all of these sellers at this particular area. So that wraps up the portion of the structure section in this particular video. Very short, sweet, simple to understand. I'm not going to go into the nitty-gritty of multiple time frames, multiple whatever. I'm a very simple trader with a profitable strategy that I don't need to complicate any further. I trade a very simple 2 risk to reward strategy using what I've just shown you here, taking advantage of this order book. So I'm not going to make things complicated for you. I'm going to show you exactly on the live chart now how you can spot this and take advantage of this. Once you've built the skeleton of your structure story, you'll be bulletproof for whatever else you are going to be trading, because you now have the backbone of exactly what the market is doing and what it needs to do, because you now understand exactly what this order book is doing. So now that we have this backbone, we're going to move over to the next criteria, where we now can perfect the timing of our entries. What are the areas, after we understand where all of these orders are lying, that we know price needs to accumulate to fulfill the opposite side in order for us to place our order to get the best reaction, the best move to maximize our profits? How do we find that area in the market? Well, that's where we call, and what we call, supply and demand zones, or aka institutional levels. In a nutshell, what supply and demand is when you see price busy ranging, chopping and changing, and then we see a big move or impulse to the downside or the upside. In this example, at the downside, that area or that range that created that big impulse is what we call an area of supply. Why? Because all of the price action that happened previous year was accumulating all of these sell orders, making the big move down to collect all of these buy orders. So we know that in the future, price will need to come back up to these sell orders to rebalance all of the buy orders before continuing its move down. Because we know at this point in the market that there was potentially very big players that entered the market here with a lot of volume, with a lot of money, and with big auctioning power. And they're likely going to have some unfilled orders lying in this area of supply, which leads to my next criteria. How can we identify those supply and demand zones with those unfulfilled orders, where we know price can potentially get the best move? As an example over here, what we will sometimes see in price is multiple supply or demand zones. Here we have a demand. Here we have a demand. Here we have a demand zone. If we continue, here we'll have a demand zone. And then here again, we'll have another demand zone. How do we know which demand zone has the unfulfilled orders for price to get the best reaction from? Well, that's where we come to our fourth criteria: volume or imbalance. An order block that creates a fair value gap, a volume, an imbalance, many different names for it. So let's dive into that step and start putting this puzzle together. In a bearish example, when we see that supply zone that's created after that strong low sweep and has now created the big impulse move to the upside with the break of structure, the difference between a valid order block that holds orders that have not been collected versus an order block that has no orders anymore versus an order block where all the orders are already collected and most likely won't get the reaction, is that supply or demand zone that holds a fair value gap. A gap between the series of 3 candles, the first candle being the order block, the next candle, and the candle after that, where there is a gap between, in a supply zone, the bottom wick of the first candle and the top wick of the third candle. This gap is an indication, a big indication, that all of the orders in the supply zone has not been fulfilled. So we can expect the best reaction from this particular supply zone. Right? Vice versa for a bullish order block. A demand zone that creates the big impulse move that has been created after the strong low sweep and takeout to the upside with the break. The difference between the demand zone that has unresting orders that haven't been collected yet, that we know will get the better reaction and the biggest reaction, is the demand zone that holds the fair value gap or the volume gap between the series of 3 candles, the first candle being the demand, candle 2 and 3, at the top of the demand wick, the first candle, and the bottom of the third candle's wick. That will indicate to us that there are unresting orders and untapped orders in this demand level. When we see that gap has now been closed and the demand zone has been tapped, we know that orders at this demand level has now been fulfilled. And we can use that to our advantage to understand what we're seeing on our candlesticks. Okay, in that demand area, the demand has already been collected to rebalance the supply. So we can now use that to our advantage to know that this is not going to be a good area in price to try to buy price if all the orders have been collected, because we can expect that there's not going to be a massive reaction from this demand zone. But when we have this gap, we know that there's still a ton of these demand orders lying, that when the selling power needs to rebalance their sell orders, they will come and collect the demand zone that has this gap, because they won't collect all the orders from this demand zone here if it's already been mitigated and if it's already been collected, because there's nothing for price to collect and run from. If this demand zone here has no orders, but this demand zone has the orders, price is going to take out this demand zone and it's going to come to the demand zone where the orders are lying to continue in its intended direction. So let's put this all together and understand what's happening in this order book here. Okay, well, if I backtrack a bit and mark out my structure story, here we have a break, that pullback, the sell orders being collected, the new break to the downside, the pullback, sell orders being collected to rebalance the demand, break to the downside, pullback, the sell orders at that particular supply zone being collected, new break to the downside, sell orders collected to rebalance the demand. What happens is, after this break, okay, we pull back, but we can't quite break structure to the downside. We then break to the upside. So what does that mean? This area, or this low, that swept the previous strong low, that has now broken structure to the upside, we know there was a lot of heavy institutional involvement here. There was a lot of buying orders that was pumped into the market here. So we know that in the future, when price returns to this level, there's going to be a very good chance for a very strong reaction and low probability that this low will fail. Okay? So that's the first criteria we've discussed. There's a sweep of our strong low and then the break of structure to the upside. The next thing that we spoke about is our order block. Well, if I zoom in here, after the strong low was swept, candle 1, candle 2, and the big candle 3 here. Remember what I taught you about the fair value gap? To know if the orders in this particular demand zone have been fulfilled or not, we take the top wick of the demand zone and the bottom wick of the third candle. And we have a look, is the wicks overlapping? No wicks overlapping, so what does this mean? This demand zone has a valid gap. So that means all of the orders in this particular demand zone has now been unfulfilled. So if I drag this across, when price returned to this area of the market, we can see how the order book, how the auction, the two-way auction is playing out. We collected all of these buy orders to continue price up to now start fulfilling more sell orders where we get that big reaction. And this was actually a recent trade that I live traded with my community last night, 2 nights ago actually, where we secured a nice 4% profit on this move. Show you the live position here where I sent it live. Give me a sec. In the limit section. There we go. On that particular demand zone. And this was the outcome which we had now recently on this market as well. Okay, just taking advantage of that order book, not doing anything fancy, following a simple criteria system that is a repeatable process in the long term that just takes advantage of this order book. It's almost like, I'm not going to say a glitch, but it's flipping cool, right? So there we go. If I take a look at another example, we'll come over to, let's do the S&P 500, which actually had a beautiful 3 trades in a row. I'm going to remove the drawings and take this from scratch with you. Okay, I've also created an indicator for my community that marks out these areas in this order book that will give you the high probability areas where we know that price will protect that particular high or low. Okay, so if we have a look here, we had a break, pullback, break. There's that strong low. There's that weak high. We had a break to the downside, a pullback, a break. So this was a strong high. This was a weak low. What did we do? We took out that strong high and then we broke structure to the downside. Okay, so that means at this high, the highest point in this particular market, there was a lot of sell orders pumped into the market. Okay, so we know in the future, when price returns to this particular range or area, that there's going to be a good reaction and a very low probability that the little demand that there is will take over all of that supply and completely overtake it. So if I zoom out, have a look what happened. There's that supply area. Well, this whole range is your supply area. The tap in, these supply orders were collected to rebalance the demand to get a beautiful reaction. And this was another live trade I took with the community. Stop at that high, just a 1 to 2R, 2% risk for 4% gain that we took together on stream. Simple, right? If I zoom out again for the second trade, what did we have here? We had a strong low, broke structure to the upside. We swept that strong low, and then we broke structure to the upside again. So we know this area of demand in the market has a lot of buy orders. So we know that when price pulls back to this area to fulfill these demand areas with all of these orders that is lying here now, there's going to be a very low probability that that low will fail because of the pure vast amount of auctioneers have bought at this level. So when price reaches there, okay, the next live trade I took with my community, look at the beautiful reaction we get. All we're doing is following a very simple fixed mechanical criteria, right? Here's the gap above that order block where we know the orders have not been collected yet. Right there, there's our big gap, candle 1, 2, 3, top of the wick, bottom of the wick. Okay, still a big gap remaining, so we know the orders have not been fulfilled yet. Okay, so that's all this is. It's a simple 5 criteria model, taking advantage of the order book, taking advantage of what is actually happening, this almost the science and the maths behind the back, almost like the dark web of the market, what's happening on the back end. And we are now taking advantage of that with a very simple single time frame 4-hour model only, where we get about a 75% win rate trading this model. And this is what is created hundreds of funded members in my community. It's what has funded my lifestyle, my cars, my home. It supports my family. It does everything I need. It gives me the freedom. Because this is something that has taken me years to develop and understand, that you now have the opportunity today to take advantage of yourself. Okay, so what I'm going to give you guys, if you guys want to join this Discord community, it's free. There's no upsell or downsell. I will be honest, the only paid aspect I have in this community is my indicator. That is done for you. It will do everything for you. My live streams every Tuesday, Thursday, and Sundays, we do back testing. 2 p.m. GMT +2 in the live trading channel. Okay, on the live trade, we'll set our limits together. Every limits that we get tagged into, I will send in the tag section, and then obviously the outcome of the results will be posted in the results. And take a look. First trade last week, 2R. We had 1 loss, +2, +2, +2. It's been a beautiful week taking advantage of this. We've also had about 4 other setups on stream as well, where that were all wins. We've only had 1 loss, 1 break even, 7 wins so far into 2025. Okay, but that's not what I want to hype you up with. What I want you to realize is the outcome of each and every individual trade does not matter. What we focus on is a long-term profitable edge and a proven edge that is sustainable, that can build true wealth in this industry. Okay, I'll leave a link down below to the Discord in the description of this video. I will leave a link to my indicator as well. There is a tutorial on how to use it in the Discord. There's my higher time frame model course. I recommend watch this before using the indicator. And then my video content focuses more on the foundational general knowledge of the markets. Okay, we dive more into liquidity in the markets, another big concept that is used to drive that order book. A big psychology lesson. I need you to watch this if you want to become profitable. And then specifically diving into prop firms, my guaranteed way to get funded risk-free, and how to pass your funding challenges. Okay, all of this, link is in the description, indicators in the description as well. I'll see you guys on the inside.